So premium discount is a tool we use to measure where price is within a leg and where price is expected to go. And if price is in premium, then it's expensive, and if it's cheap, it's in discount. So what we do is we draw on our tool from the high of the swing to the low of the swing, and I use the Gann box, or you can use, there's a fib tool, and you can use this, and you can mark up premium discount. So here I have the 25%, 50% and 75%. But nowadays I just use the 50% because you've got premium at the top and you've got discount at the bottom, and it's much easier. So what we're expecting when we draw on our tool is for price, when it starts retracing, to retrace to at least the EQ of the range, so at least to here. And any supplies above this area, above the EQ, is where we're looking to sell from. And this is just a confluence, so obviously there could be a supply down here which looks nice and it flipped this demand, so that could be a good supply to sell from. So we're not using it as a 100% confluence or 100% rule, but it's more of a confluence to look for price to retrace to there. Okay, so say we've got a supply up here, then we're expecting price to get to there, and that's in premium, so we can say that's a good place to sell from, opposed to one down here. But like I said, it does depend on the situation. And the same for bullish market. So we draw on from the high, from the low to the high, and we're expecting price to come to a demand in discount down here, because when it's in discount we know it's at a good price to buy, in order to look for it to go higher than this structure. So in the next video we're going to be looking at some examples of this and applying that to the market and seeing which supplies and demands get a reaction and which ones follow through, whether they're in premium or discount,